Inflation is up, but rates are down? Yep, you heard that right. CPI just hit 2.9%, but the Fed is still worried about a recession. Stick around to find out why housing data and weak job revisions matter. These factors could still lead us to a rate cut, and you don't want to miss it. Let's dive into the numbers and see what it all means for you.
So number one, the CPI rose and was above expectations. The Fed is still going to cut. So the recent uptick in the CPI, which was driven mainly by shelter, housing, there's another one of those terms, the Federal Reserve's decision-making process for interest rates cuts this month. How's that been affected?
Well, so for clarity, the Fed hasn't cut yet. I expect they're going to later this week. But last week, we got the CPI, that stands for the Consumer Price Index. Whenever people talk about inflation, that's typically what they're referring to. When people say, inflation is up 2.5%, they're referring to the CPI. In this case, we got an overall increase of 2.9%. That was up from 2.7% last month. And the monthly change, which normally I don't pay a lot of attention to, but it was actually a pretty hot number. The monthly change was up 0.4%. Doesn't sound like much, but it annualizes to just under 5%. That's 2.5 times the 2% target, which itself is 2% too high. The core CPI, that number excludes food and energy. That was up 3.1%, consistent with last month. People are still saying, well, the Fed should cut. And by the way, they're going to. They're going to do that later this week. But I'm just going to point out they're doing it with these inflation metrics right around 3%, which from the Fed's point of view is 50% over the target. From my point of view is 3% too high. The other thing that I would add is you were correct in pointing out that the primary reason for the increase was shelter, right? Again, just a fancy word for housing. That's how the Bureau of Labor Statistics refers to it. And in this case, the housing statistics are lagged. And that just means we're now getting reports from months and months ago. It just takes a long time when a real estate deal is done for that to move its way through the system. And if any of you have ever bought property, it's not like you come to an agreement and you sign the papers and the mortgage the next day. It usually takes a few months to get everything complete. So we've got this lagging number, and I think we're going to see a decrease in the coming months in OER, that stands for Owner's Equivalent Rent, which is the completely ridiculous made-up way the Bureau of Labor Statistics looks at shelter. In other words, the CPI is high now, but I think it's going to come down in the coming months. There is zero evidence that tariffs have been a problem, and that's something that, fiat economists were hysterical over. President Trump was going to ruin the economy. Nobody was going to have money for anything, except tariffs have not led to big problems, and we're not seeing big increases in the durable goods category.
I know it's really strange, isn't it? Because it has almost been one of those tenets of classical economics that things like tariffs get in the way of free trade. Do you think free trade has been affected in any ways by the tariffs?
So here's the thing, Phil. I love that you're using that term, free trade, because it's an academic finance term. When PhD level economists get together, they talk about free trade because, hey, that's a good thing. And they talk about Porter's theory and comparative advantage. Okay, great. And these are things that were great in a classroom. They were great in academia. They were great in theory. But in reality, this is not what happens. Every country has some level of protection. And one thing that really entertained me when I was in Lisbon a couple of months ago, all of the European central bankers and the economists, they met in Sintra, Portugal, just like, 15, 20 miles away. Chairman Jerome Powell of the Federal Reserve got a standing ovation for saying, the tariffs were going to cause inflation. They like that, except, Bill, I've had things sent to me here from the United States. Guess what? 33% tariffs on the stuff I've had shipped to me here. So they're against the tariffs on their products. They want access to the US market, but somehow it's not a disaster for them to tariff US goods going there. On top of that, everybody plays games with protection. As an example, Airbus, the French company, the European aircraft maker, they're subsidized by the state. That's just another way of giving them a comparative advantage of paying for it. Now, our European friends watching this might say, hey, wait a minute, your entire defense sector is funded by the state. Your government overpays them for things. Yes, they do. Everybody is cheating on this. So this free trade mirage, it exists in a vacuum. It doesn't exist in reality. On top of all that, the United States has had an issue. We have spent the last 40 plus years outsourcing everything, and we've sold off all of our industries. We no longer have the ability, we no longer have the ability to make things like semiconductors. Yeah, Intel makes, but at the very highest level, we don't make our own pharmaceuticals. We don't make our own protective gear. We can't make our own ships. This is a problem. And eventually, we really do need to start reshoring manufacturing for security reasons, for jobs. It's the other thing too is it's really easy to say, well, you've got tariffs, so the price of things will go up. Again, in a vacuum, in a classroom. But that's not what happens in real life. In real life, you end up with substitution and you end up with an increase in domestic manufacturing capacity. We talked about this a couple of weeks ago, where the automakers were saying, oh no, the steel tariffs are going to kill us, except guess what? We have falling steel prices. Domestic manufacturing has increased. And so everybody does the static analysis, but the world is dynamic. If you change one thing, everything else changes. And so the analysis they're doing just isn't relevant.
So President Trump has been applying a lot of pressure to Fed Chairman Jerome Powell. Why does he want lower interest rates, and what is the pushback that's coming from the Fed?
So the reason the president wants lower interest rates is because the economy will run hot. Don't worry, I'll explain it. So if you have lower interest rates, what it does is allows people to borrow at lower rates, theoretically, not always. That didn't happen a year ago, but let's move past that now. And then if financing costs are lower, people are incentivized to build factories, to build plants, to invest in projects, to do a lot of real estate projects. We'll talk about that later, Phil. I know you've got comments on that, right? But that's, lower rates incentivizes building, but it also blows up asset bubbles and makes things very, very expensive, right? If everybody's trying to do this stuff, you will have asset bubbles, and that works its way through the stock market as well. And President Trump is somebody who likes to judge his command of the economy and his success through the stock market. Well, lower interest rates means you're discounting future earnings of companies at a slower rate, which leads to higher equity valuations. So you blow up these bubbles. Well, why would Chairman Powell of the Federal Reserve be against that? Because they're trying to control inflation. And when you blow up asset bubbles and asset prices increase, you get inflation. That's exactly what the Fed doesn't want to do. Now, people have been saying, and I'm about to release a long macro piece where we talk about this. People have been saying, oh, the president is politicizing the Fed. Guess what? The Fed has always been a political institution. For the first 20 plus years after it was created, the Secretary of the Treasury was also the chairman of the Federal Reserve. The Fed back in the 1980s accommodated President Roosevelt's desire for an expansion of the welfare state. President Lyndon Johnson, a few decades later, literally picked up Arthur Burns and slammed him into a wall, strong-arming him into lowering rates. President Nixon pressured Burns to keep rates low to help his reelection. I mean, we've just seen this again and again and again. And I think it's hilarious that people are saying, oh no, President Trump is politicizing the Federal Reserve. Well, what did they think the Federal Reserve was doing a year ago in September when they lowered the Fed funds rate with inflation running hot just ahead of the November elections? It's no secret that everyone in that building despises the president. The Fed has always been a political institution. The only difference now is when Lyndon Johnson picked up Arthur Burns and slammed him into a wall, he did it in private. President Trump's castigating Chairman Powell in public. The only difference is we now have front row seats to watch the show and X or Twitter to discuss it.
So what's your crystal ball saying, Gary? Are we heading into inflation or another asset bubble or both? Stagflation. Some people are saying
above. Yeah. So here's my crystal ball. We'll see. We'll know more. I think later this week, the Fed reduces the Fed funds rate by 25 basis points. Again, just a fancy finance way of saying 1/4 of 1% or 0.25%. I think we get a short-term decrease in the CPI as the OER, the owner's equivalent rent for shelter, comes down and starts to reflect market dynamics. And then I think we're going to have long-term increases in inflation. And the reason for that is congressional overspending. It has nothing to do with President Trump, nothing to do with Chairman Powell. It's really just the fact that Congress overspends, and whether you're on Team Red or Team Blue, everybody spends too much.